Welcome to the Midday Market Update for February 11th, 2021. My name's Kevin Hill, here as always with the Michael Vincent on this.
Hey, good afternoon.
Good afternoon.
It's a frothy fall winter day here.
It is frothy. It definitely is.
I mean, the rain's coming down. You know, it does
Snow,
it does though in the spring here. Actually, in all seriousness, get frothy out here. Have you witnessed the pine, the yellow sludge that bubbles up when it rains in the spring here?
I have,
from the pine pollen. Yes. It's quite frothy.
I come from a place with very few trees, so getting this much pollen is a shock to the system sometimes.
It is.
Well, this is our interactive show that covers the freight markets and today's headlines, and it is all interactive. Facebook, LinkedIn. I'm about to pull up LinkedIn right here.
Yeah, absolutely. Get your questions and comments in. We'll get to those as best we possibly can and ask our guests those that are appropriate for those guests. And speaking of guests, we got a couple good ones here. We got Alan Adler, right? Our what is he? Detroit Bureau Chief.
He is. He's
talking about SPACs.
He's been covering SPACs quite a bit, and it's a frothy market. You know, there's a bubble forming in SPACs, I think.
How frothy is that bubble going, right?
It is. It seems like everyone is on the SPAC train. I just saw a headline too that the SPAC train. Colin Kaepernick is doing a SPAC. I saw that headline last night.
Is he really?
He is. You know, I think the Kardashians are too. I mean, it's like everyone.
It's like the hip thing to do now, huh?
It is. It is. It's what the influencers are doing these days.
Okay.
So we have that, and then we have.
We got Billy D, Mr. William Driegert of Uber, head of operations at Uber, talking about technology, bringing technology for small shippers in the small shipper market and what they're doing there at Uber. Talking about that market should be very, very interesting. Always a good time talking to, and very informative talking to Bill. So that'll be good. And then we have our usuals. We got Nick Austin on for doing the weather. We've got some issues happening in your neck of the woods.
We do, yes.
Your old stomping grounds. Zach Strickland on Sonar and Anthony Smith talking economic news, right? He's got the unemployment numbers today, right?
Initial jobless claims comes out today, so we'll see how that's trending.
Yeah.
But let's start it off with Andrew Cox and the top headlines from FreightWaves.com. If you're not a subscriber to our newsletter that goes out right now at noon, go to FreightWaves.com and sign up. But let's go to the first headline, Andrew Cox.
Hey, Kevin. Legislation aimed at bailing out multi-employer pension funds in danger of failing could finally make it under law in the latest COVID-19 relief measure. The Butch Lewis Emergency Pension Plan Relief Act of 2021 is a piece of legislation that the Ways and Means Committee in the House of Representatives is considering this week to include in a broader COVID-19 stimulus package. This would allow a plan that is in critical status at the start of 2020 or 2021 to extend its rehabilitation period by 5 years. This would give the plan additional time to improve its contribution rates, limit benefit accruals, and maintain plan funding, all on its own terms. The largest pension plan in danger of failing is the International Brotherhood of Teamsters Central States Pension Fund, which represents more than 1 million participants. Representative Richard Neal of Massachusetts is the Ways and Means Committee chairman, and he's tried several times over the previous 3 years to pass multi-employer pension reform legislation. The major difference between the 2021 legislation and previous bills is the source of the money. This legislation would allow employees to retain 100% of their benefits and will be allocated directly from the U.S. Treasury rather than being generated by the sale of Treasury bonds. Prior bills included a loan payback program that would be paid to the Treasury over 30 years. But this is an outright cash infusion with no obligation to pay it back. Recent multi-employer reform proposals haven't made it past the Senate. However, with Democrats looking to pass COVID-19 relief through budget reconciliation, a process only requiring a simple majority of 51 votes rather than 60 in the Senate, if the 2021 pension proposal makes it to the Senate floor, it has its best shot in years of getting to the president's desk. Fellas.
Yeah. So, what's your thought? Is this a bailout that's going on here again for kind of like a YRC thing, or are they not on the hook for the pensions?
Are you asking me?
I'm asking Andrew.
Andrew, what do you think?
Well, I mean, these pension plans are in major trouble right now. One of the executives helping write this helping write this proposal, said that both ABF, the ArcBest parent company, and the Yellow Corp should be applauding these efforts because it is a gift to many of their struggling pension funds. So I don't know if I'd go as far to say it's a complete bailout, but it's definitely help that is needed for these pension funds to get funded and try to get back on the right track.
Yeah, I agree. For those that are in those pension funds that need those benefits, it's definitely a good thing.
It is a good thing for shore up those pensions, whether it's the fair thing to do. Who knows? But we have Big Rick Barbie says hi. Fish Transportation says hello. Derek Staples is in the house saying hello from California. Amanda Miller and Rhonda from Global Trans all are up here. So we have Billy D coming on from Uber coming up, but Uber did release their Q4 2020 earnings yesterday. What do we have there, Andrew?
Yeah, Kevin, Uber Freight posted significant year-over-year gains in both revenue and EBITDA for Uber Freight in the fourth quarter. What Uber calls gross bookings is a proxy for revenue. That rose to $313 million for the fourth quarter, up from $219 million in the fourth quarter of last year. That represents a 43% jump. Sequentially, the fourth quarter improved upon the third. In the third quarter of 2020, Uber Freight recorded revenue of $288 million for a fourth quarter gain of just under 9%. Meanwhile, adjusted EBITDA for Uber Freight narrowed to a loss of just $41 million after a loss of $55 million last year. This also improved sequentially because in the third quarter, adjusted EBITDA for Uber Freight was at negative $73 million. Uber said one of the reasons for the improved performance at Uber Freight was the Uber Freight Enterprise offering that rolled out in September. The service gives shippers more control over their freight and provides greater visibility into a route, including estimated delivery times and estimated times of arrival and digital documents. In his remarks at the start of the earnings call with analyst CFO Nelson Chan said that there was a 45% quarter-over-quarter increase in the size of Uber Freight's active user base. In the company's earnings slide deck, Uber provided some current metrics on Uber Freight, and the division's run rate at the end of the year amassed to a total of $1.3 billion, and the number of carriers on the Uber Freight platform that had joined via its app was at 71,000. Fellas?
Yeah, it's a jump on that top line revenue, right, Andrew? I mean, that's one of the numbers that sticks out.
Yeah, absolutely. Uber Freight is still growing very fast, actually accelerating growth from last year, and at the same time, they're narrowing EBITDA margins. Of course, that is a time, in the fourth quarter there, they had a time where they could actually expand margins a little bit, so that's good for Uber Freight. We'll see how 2021 plays out, but strong growth. They have strong demand from both shippers, and they have now a large enough network of owner-operators and carriers on the network to supply both sides.
Yeah, and like you said, Kevin, we have Bill Driegert, head of operations, on later, and we'll talk about some of the stuff. I don't know if we'll get into this that much, but if you recall, we had him on this show last year, and asked him quite frankly and straight up whether Uber was looking at divesting of Uber Freight. Remember when those rumors were going on?
Yeah, those rumors.
And he stated no. He said absolutely not, and so did Uber as well. State absolutely not. They weren't divesting. In fact, they were bringing out more products to improve that and go to go revenue positive.
And they got
the shippers, and it seems like they're executing quite well so far and moving in that direction.
Yeah, and they got a nice equity raise from Greenbrier, $500 million. So,
that's right.
And then they're including, as each quarter goes along, the Uber company is, the parent company is offering more and more highlights and in-depth information on Uber Freight and the freight market. So it was one maybe a year ago. They didn't break out results whatsoever.
That's
but now
right.
they're getting more detailed in the results, which is a good sign for Uber Freight.
Yeah.
So, Andrew, reshoring. What are the trends going on with BDO's recent survey on that?
According to the 2021 BDO Manufacturing CFO Outlook Survey, 24% of manufacturing CFOs said that they plan to relocate part of their supply chains to another country in 2021, with the U.S. topping locations manufacturers saw as the most stable market for sourcing materials. Industry-wide shocks were felt throughout COVID-19, especially for those dependent on Chinese production, which admittedly is nearly every industry. According to the survey, 82% of manufacturers across subsectors experienced production halts in the last 6 months at least some of their locations, and companies are now looking to diversify their suppliers and bring them closer to home. The cost to manufacture in China is still cheaper than in the U.S. and Europe, according to R.J. Romano, a supply chain practice leader at the BDO Consultancy Group. But due to the pandemic and the shift in consumer expectations, companies' supply chains want sourcing that's closer to home. Romano said that there were some unexpected findings of the survey that CFOs actually ranked meeting higher customer expectations as more important than mitigating supply chain risk. This is evidenced by a 30% of manufacturers planning to pivot to a direct-to-consumer e-commerce model in 2021. Another variable to watch is the federal government. President Biden's recent Buy American executive order could potentially incentivize companies to reshore some of their production to the U.S., but it's too early to tell. Based on Biden's recent executive order and what was said on the campaign trail, it's safe to assume his administration will push for more policies aimed at strengthening U.S. manufacturing. It would likely translate to legislation that encourages or incentivizes the nearshoring or reshoring of manufacturing properties back to the U.S.
So on the nearshoring, I mean, there's been a lot of disruption, certainly in China, and everything that's international on manufacturing and goods production. China's seen a rise in wages over the last 10, 15 years. Mm-hmm. And when we talk about nearshoring, it's still cheaper in China than probably U.S. or Europe. But I think places like Mexico, when we're talking about U.S.-based manufacturers nearshoring back to the Western Hemisphere, and Latin America too, are making strides, right, Andrew?
Yeah, that's exactly right, Kevin. Mexico is one of the biggest beneficiaries of this nearshoring strategy that will be playing out over the next couple of years. The new USMCA is certainly going to aid in this as well. In the automotive industry in particular, they've increased the percentage of parts that must be sourced from North America from 63 to 75%. So that will certainly benefit some nearshoring of automotive parts to the U.S. and to Mexico. So yes, Mexico is definitely a big beneficiary here in this nearshoring.
Yeah, it's kind of a buy North American in lieu of like buy American, right? Which benefits, which really does benefit us and benefit the United States and industry. It's very interesting to see how much of this do you feel is really. I mean, I get the idea. We've been talking about it ever since we started with the nearshoring and changing and diversifying your sources, et cetera, and meeting those consumer expectations. But is this a knee-jerk reaction that happens and then starts to filter back out as those disruptions in the supply chain start to work their kinks out over the years, right? And we start to and we find ourselves full circle again. It feels kind of something like that to me.
Yeah, definitely. So Andrew, Point of Sale, your newsletter that covers the retail, supply chain, and transportation markets comes out at 1 p.m. today. What's a quick synopsis of that?
Yeah, well, the retail inventory restocking thesis has been touted by nearly every industry analyst, us included, as a promising growth driver for the freight industry, given the continued strength in consumer demand and the relatively low inventory to sales ratios. And while this holds true for most industry segments, apparel companies are a different story. Apparel companies, unlike most other retail categories, have more inventory on hand than usual, a lot more. McKinsey & Company estimates that the value of unsold clothing in warehouses and stores worldwide ranges between 170 and 190 billion. That's more than double normal times. And that number would be even higher if brands hadn't have conservatively ordered for fall and winter. After seeing the spring season ruined for everyone not selling sweatpants, brands slashed orders and ran lean through the year end. This did wonders for apparel margins in Q4 when retailers had little to sell at the end of the year. But retailers are left with a glut of spring and summer inventory. From February to April, retail sales, apparel clothing sales fell 87%. So brands have entire seasons worth of stock from last year, but apparel ages like milk. And apparel companies now must walk a tightrope, balancing the desire to grow and gain market share after a year of record bankruptcies and record store closures with the lean, mean, no discount machine that powered many retailers to higher profits on lower sales in Q4.
Interesting. So where do we reach out and subscribe to Point of Sale, Andrew?
You can go to FreightWaves.com/POS. Like I said, it'll be coming out today about 1:30. Be on the lookout for that today.
Thank you. Thank you very much, Andrew. So Kudeep Johel says, hello, Sunshine in Canada. We haul on Uber loads in Canada. We're all good. So
yeah.
This is good.
Yep.
And then Calissa Carver, or Big Rick Barbie, says, I hope Uber Freight does well in package delivery. People who lost jobs in retail may pick up work in logistics. Jobs just don't evaporate, they migrate, and hope that they can help our people who have been displaced by the pandemic.
Yeah, absolutely. I mean, I think she's looking at Uber, not Uber Freight.
Yes.
Right?
Yes.
Utilizing the Uber drivers, et cetera, for parcel delivery and
Yes,
final mile, that type of stuff. Yeah, but nonetheless, I concur with her. I concur. So,
yeah, it's been a crazy weather. Over the last 7, 10 days.
It is, and I was a little concerned Tuesday when Nick said, just watch yourselves from really from Texas to the Mid-Atlantic, which is like a big swath. So I think we have him here to kind of explain a little bit more what's going on there. I think it might be
all Nick's fault because he saw his shadow.
That's
6 weeks ago. What do we have latest on the weather, Nick?
Well, just like you guys said, from Texas all the way to West Virginia, the Mid-Atlantic, just terrible weather. We're talking about freezing rain and a lot of areas where the roads have just been icing up. A major wreck in the Fort Worth area. We'll have more on that a little bit later in the show. There have been problems in Memphis with trees and power lines down up into Kentucky. Arkansas, you name it. I mean, all across a lot of those southern states. Ice is just the worst, and it's just going to keep going through the day. So some areas could see up to a ½ an inch of ice accumulation in some isolated pockets, maybe even up to 3/4 of an inch. That's a lot. I mean, just tree branches getting way down, power lines getting way down. There are tens of thousands of power outages across Texas and then Kentucky and West Virginia right now. So we'll go to critical events. We'll take a look at it as far as the radar up on the map. The areas that you see all colored into pink, that is where most of the freezing rain and even some sleet is falling. Kind of on the edge of where the snow is in the blue. So it's happening in a lot of spots here, and it's going to continue through the day. It's not really going to fade out until maybe later in the afternoon or into the evening, and then there'll be kind of some remnants of freezing rain and snow left over for Friday in parts of the Mid-Atlantic. But even though the precipitation may kind of fade later today, the impacts of this storm are going to last into Friday and into the weekend because Arctic air is kind of slipping southward. It's going to stay cold in a lot of these areas. A lot of these roads are going to stay frozen, and the power outages are going to last for several days probably in some of these areas as well. And not only that, but in Texas and other parts of the southern plains, a snowstorm can be coming right behind this storm, heading up into the last half of the weekend for Valentine's Day, into the first part of next week. Some parts of the country that just aren't used to seeing accumulating snow, maybe even all the way as far south as Houston, Texas. And we'll get into more detail about that later in the show as well. I think we have a picture that we're going to pop up. This is from northeast Arkansas last night, I-55 near Blytheville, Arkansas, where a tractor trailer flipped over as the roads were starting to get icy there. And this has been the story in a lot of areas across several states where this freezing rain and the ice have been forming. And I hope that driver is okay. The wreck in Fort Worth is a lot worse. It involved dozens of cars and trucks, and we'll have a little more detail and I think some video later in the show of the crash that happened out there. So this is going to last through the rest of the day and probably tonight with those impacts going on through the weekend, guys.
Hey, Nick, one more time for the drivers out there. Where's that line where they got to be looking out for that freezing rain and that mix? Where is that? It looks like it's going up from Texas right up through West Virginia.
Basically from kind of central and eastern Texas. It looks like it's south of Interstate 20 in Texas, and then up towards northeast Arkansas into western Tennessee, the Missouri Boot Hill, southern Illinois, and then across most of Kentucky there's going to be problems, especially from Lexington southward. So like you said, that covers a pretty broad swath from west to east. From north to south, it's a little bit more narrow, but it's causing enough problems. The further south you go, I'd say towards far southern Texas and along the Gulf Coast, it's going to be all rain and some thunderstorms. So from north to south, it's a little bit more of a narrow range. But from west to east, it's really broad. And so there are going to be problems, all the way up into parts of Maryland, maybe even up into Baltimore, Washington, Philadelphia later today and into Friday, where the storm is going to linger for the end of the week.
Excellent.
Thank you very much for that, Nick. We'll check back with you at the end of the show. And
just wanted to get that out. Where that ice is to be watching for, and really that cross between the rain and into the sleet and so on. That's your dangerous area where you're riding and it's wet and you're fine, and then it can change on you in a heartbeat, like you saw with that truck.
It's just weird weather. So I got a text this morning from Bob Walker, who works for me in Tulsa, and they're talking about lake effect snow from a lake around. I know, right? You're
In
familiar.
Tulsa?
Yeah, I know, right? That's normal for you where you grew up, right?
Yeah, yeah.
Lake effect
You had
snow,
that
but
engine going all
lake effect snow it doesn't exist until today. And
yeah, it was weird up there because I mean it's counterintuitive if people didn't grow up there. The warmer it stayed into the fall, the longer it stayed warm, I should say, into the fall, the more snow we'd get.
Yeah,
because the longer that Lake Erie kept from freezing, man, you just get hammered with snow. But once it froze over, then it started getting good. So,
let's check in with Zach Strickland, our Director of Freight Market Intelligence, see if the freight markets are freezing up or heating up.
Yeah, Kevin. So we're watching our tender rejection index actually take the biggest dive since it's taken coming out of the Christmas, New Year's holiday period earlier this week. So it dropped from about 21.5% all the way down to 20.8, or just below 20.8%, 2 days ago. Again, a lot of this was driven by a large recovery in the northeastern corridor. The Harrisburg market, Allentown market specifically, Elizabeth as well, all had recoveries from last week's winter storm impacts. So that drove tender rejection rates down pretty significantly there. The Harrisburg market fell from 26.8 to 22.8% tender rejection, outbound tender rejection index rates in 3 days. So that's the biggest driving force behind that plummet. Now, over the last day, we did see another uptick, so it kind of bounced off that floor on the national index side. So capacity still very tight, over 20% overall, and that uptick seems to be attributed to what Nick Austin was talking about here just recently in that Central States winter storm event. So a lot of icing going on right now. Little Rock, Memphis. Memphis actually had a pretty significant jump in tender rejection index rates over the last couple of days. Whether that's foreseen because of this or not is hard to tell. But just about everywhere in the central part of the United States, from Milwaukee all the way south to Dallas, saw a pretty decent little jump in tender rejection rates. So the cold weather, the winter weather, like we talked about a few days ago, is going to have a little bit more notable impact to a market when it's already significantly tight. In a normal market, there's a lot of extra vehicles out there able to recover capacity when service failures occur or when trucks get stalled out, when there's major accidents, like we saw in Fort Worth. There's other available equipment sitting around in a lot of those markets. When we're seeing those tender rejection rates like we did last year, about 5-6% this time last year, when you're seeing 20% tender rejection rates, those trucks are largely already being utilized somewhere else. So these storms, and it looks like this pattern is going to be persistent for the next couple of weeks at least, as these things train over a lot of cold air coming through the middle part of the country. The Chicago market's going to definitely be one to watch as they keep having this consistent snow coming over the top of it, and they haven't had this type of weather in a few years.
They haven't, Zach, and watching a lot of these areas, you've got some, although the United States overall, the outbound tender volume's kind of hovering there in that 13.6, 13.7, right? A little bit up, a little bit down, but certainly at least a slow trickle down, right? But there are markets that are jumping up in certain areas and quite significantly in some of those as far as outbound volume, tender volumes. And when you have that type of volatility with the winter weather, these ice storms, et cetera, it seems to really exacerbate the problem, would you say?
Yeah, exactly. And one of the markets that's been hit by all this winter weather here recently, but has also been tightening on its own without any help from nature, is the Cape Girardeau market down there just north of the Memphis market. Has been tightening significantly since the start of the year. So it's a little contradictory to the rest of the market. We've increased from about a 30% tender rejection rate starting the year to over 42% at this point. And that's largely independent of all this weather. So like I said before, this winter weather is only going to exacerbate the conditions of the market, especially when they come over the top of markets that are already kind of, that Cape Girardeau is not necessarily a target market for a lot of carriers. So when you do have these conditions exacerbate, the tightness in bigger markets, it's definitely going to trickle down to these smaller markets in a lot more prominence.
Yeah, and Big Rig Barbie says she's over in St. Genevieve, Missouri, over by, I think that's St. Louis. It's an ice skating rink on the roads here in Missouri. I'm pulled over here because there were 12 trucks in the ditch on I-55.
Wow. Wow.
Yeah, so
Stay safe
good.
out there.
Yeah. Well, thank you very much for the freight market update, Zach, and we will catch you on the next episode. But let's talk about unemployment now and initial jobless claims, the economy, and seeing where that might be driving those tender rejection rates in the future, depending on economic output. We also have PJ Zarkis here, co-founder at Logistics Talent Sourcing. The freight market definitely had a peak due to the weather. Also, trailer truck shortages aren't helping. And I think we can all agree with that. William Rufo, Cape Girardeau's has a large Procter & Gamble facility there. So trucks coming in and out.
There you go.
There you
go. Lots of volume.
And that's where Big Rig Barbie is. That's where I am, near Cape Girardeau. So I was thinking, the town she mentioned was more closely to St. Louis, but I guess it's down in Cape Girardeau.
Yeah, I'm not.
In Mark Twain country.
Mark Twain.
Mark Twain country. Yeah.
Right.
So let's talk about initial jobless claims right now with our lead economist, Anthony Smith.
That's right, Kevin. Michael, we have initial jobs claims and hoping that Big Rig Barbie stays safe out there in that crazy weather. But for the unemployment scene, as you know from the last episode for this, I was skeptical. The skepticism grows this episode as well. We have initial jobs claims that came in just under 800,000, just around 790 some odd thousand initial jobs claims. So there was a decline from last week that was just over around 800,000. But the skepticism comes in because there was an upward revision in the previous report that was around 779,000. And it got an upward revision of around 33,000 initial claims. And so this is a significant bump and a rather large bump. Usually we just see a few thousand on the revised numbers, but a 33,000 increase from last report is kind of out there. And that's telling me that there is some issues with recording these numbers. So if you remember in the last episode, we were talking about the unemployment rate coming in at 6.3%, not really truly being an accurate depiction of what's going on within the employment market, especially when you look at permanent job loss or discouraged workers, and likely a lot higher than what's being reported. So I think this kind of adds to some of the murkiness around the, the understanding of what's going on with employment overall.
It's interesting, Anthony. So just a quick question for you. So if people are, so they're looking at the Biden administration comes in and they're talking about a third check, right? And they're looking at some fairly significant things for child care, like $3,000 or something like that per child, or to be doled out, that type of thing. But with the possibility very, very good now for a third check. Are some of those people just sitting tight with, we've had the recent spikes and stuff, so people aren't even bothering looking for work? Is that why these numbers, you're thinking these numbers are a little bit deflated, I suppose?
There's certainly something to, I think earlier on during the pandemic, I think there was quite a lot of incentive. And I think that was some of the power behind it, or some of the intention behind it, for individuals to stay remote or stay at home rather than go out and force some work hours and put themselves in an unsafe work environment. So I think early on that was definitely some of the incentive. I think now we're looking at some regulations. We're looking at dining restrictions or restrictions throughout the country, and certain states opening up a little bit quicker than others. I think when you look at places like Florida, a lot of those areas within Florida are very much open, Texas compared to New York and many parts of California. So I think it's going to be definitely industry-based, and there might be some incentives for some people to file for those initial claims if they are indeed going to make more on this time around than if they were to go back to the workforce. But there seems to be much more restrictions proposed this time around. I think last time there was going to be some tightening up of benefits as you get higher above 70,000. Now there's been some proposals of only giving those benefits to those that are under 40,000. That's been proposed, but nothing's finalized yet. But there is certainly something to some people perhaps waiting to see if they're going to make more indeed off this next round of stimulus, if they're unemployed or not.
So we have Kelly Mansfield telling Big Rig Barbie to stay safe. Rick Winstrom expect job losses to continue with energy cost increases. And I don't know if we have too much information or you do on energy costs, but let's flip over to the consumer spending and combine that with the stimulus. I know it's been hovering pretty steady. When's the next economic spending data release coming out, Anthony?
Sure. So we just had, of course, our quarterly GDP number that came out, showed us some numbers around personal consumption expenditures. We saw some rise in PCE of durable goods, so that was nice for freight volumes and flows of that nature. We should be getting a new retail sales number on Monday, along with industrial production. That should be updated. I believe that's going to be on the 15th. So we should get those numbers out Monday or Tuesday, if I'm correct on these calendars here. So expecting to see likely some more deceleration. I don't have any overt expectations for this upcoming report. We saw, I believe it was around a 5% decline for non-store retailers last report, which wasn't too big of a surprise. Just kind of seeing how the impact of spending has been for consumers moving towards the latter half of 2020 with any kind of stimulus put in place for months. So I think nothing too crazy and nothing too overtly high in this next report for retail sales, but definitely going to be looking closely for building product materials, furniture, and non-store retail sales.
It'll be interesting. I'll be looking out for that number and having you back on Tuesday to talk about consumer spending. Anthony, thank you for your insights today, and have a good one. So yeah, it's consumer sentiment, consumer spending. It's all about that, right? You know, this economy of ours is driven by that, whether you like it or not. That's the biggest driver is consumers. You know what else is just driving the not the freight markets, but the stock markets? SPACs. SPACs are the new trend everyone is riding, and we have our very own Alan Adler, our Detroit Bureau Chief, here joining us right now to talk about SPACs.
Hi guys, how are you?
Good, Alan. Hey, to begin off, let's a quick introduction to SPACs and what exactly they are, because it still confuses a lot of people.
Sure. Let's start with the definition. A SPAC is a special purpose acquisition company. They go by several different names. One is called a blank check company, which essentially means that investors are turning over their money to a company in an initial public offering without having any idea what that company is going to merge with or what it's going to become. Because the company itself doesn't have a business. Its only business is to go find something it wants to merge with. So when these IPOs are raised, and some of them are, they tend to be over 200 million, usually a little higher than that, they are done kind of on faith. The investors are coming in and they're saying, yeah, we think we can go find something. Obviously, our interest in what we've been covering here has been mostly the interest in electric vehicle and infrastructure, things like that. SPACs have a couple of interesting differences from IPOs. They are essentially a different way to go public. They don't take as long, and they do allow the companies that are going public to talk much more about their projections, about what they expect their business will be than a standard IPO does. So there are advantages. There are also, probably some disadvantages because you don't have as much time, for example, to do due diligence on a company. We saw that a little bit maybe with Nikola. And, so there are some downsides, but right now you can't stop this train, Kevin. I mean, it is 135 SPACs just in the first 5 weeks of the year.
Wow. How many did we have in all of 2020?
248.
How many?
Wow. 200.
I'm sorry, 248 last year. 2019, it was 59 or some number like that. So you had this incredible increase last year. And like I say, train is just running hard right now.
So where's the crossing that derails this train? Or do you see it just keep on rolling?
Kevin says it's a bubble. I think he's right. I think there is a bubble here, and at some point it may pop. But Michael, what you're going to have is you're going to have some losers in this, right? Some of these companies aren't going to make it because they're being, invested in by companies that don't know the business, for example. And it may or may not be the case for electrification, but for a lot of the companies that are raising SPACs, and it's a big thing with celebrities right now, they're loving it. But really, I think, you're going to have some that just don't make it.
And
Yeah.
Big Rick Barbie says 2021, the year of the SPACs, ? And I agree. I think it is the year of the SPACs. We've had a couple that recently went off, Exos and Hyzon Motors.
Yeah.
But what you see with a lot of these, and not necessarily those, but you see pre-revenue companies with these 5-year cash flow and revenue projections of, from $0 to $2 billion in revenue in 5 years, which is, I would have to say, easier said than done.
Yeah, absolutely. And the ones that the SPACs that you want to look at, quite honestly, are the ones that start out with some money. Look at a Proterra, which is electric bus company. It's been out there for about 10 years, and it has real revenue. It just went into a SPAC. You've got some others, Romeo Power, which is a battery maker. They've got revenue. They just went into a SPAC. But for every one of those, you might have 3 or 4 that are, as you call it, Kevin, pre-revenue. One of the interesting things you're seeing right now, you mentioned a couple stories that we've done this week. One on Hyzon, which is a spin-off of a fuel cell company out of Singapore. They don't have any revenue to speak of right now, but they've got a great track record in terms of having fuel cells in production and on the roads in Asia. Hyzon, basically, and it's interesting because you'll see the financial news services, the Reuters and the Bloombergs, that are getting leaks on these things. And what that's doing is kind of interesting because there's a second part of a SPAC I didn't explain, and that's what's called a PIPE. That's a private investment in public equity. And it basically raises extra money to put into whatever the target company is, the SPAC target. And what's happening is these companies are getting, the word out that, hey, we've got a SPAC at work, and why don't you PIPE players, come on in here. A couple of your regulars are BlackRock, Fidelity. They get in on almost every one of these at some level. And, they're buying shares at $10. There's not much risk for them at all. And then, so that's helping build these pipes. It's interesting you mentioned XOS Trucking, formerly known as Thor Trucks. They don't have a SPAC yet, but they've got the rumor out there. And if it happens, they'll probably have a nice pipe with it.
Yeah, and there's been a couple of rumors. We have a lot of electric vehicles, but there's a couple of Transfix being one of the digital freight brokers that was rumored in, I believe, Bloomberg a few months ago about exploring SPACs as well. So you're seeing that spread out through. I mean, it's spread out through every single industry, especially anything to do with technology. I think SPACs are a great alternative for raising capital right now. Wouldn't you agree, Alan?
I would agree. And the other thing that they line up so well with, quite honestly, you hear words like decarbonization, ESG, which is environmental, social, and governance. They line up really well with the ESG stuff. That's why BlackRock is so heavy. They were early, with $7 trillion to invest. They were very early to say, we're not going to invest in companies that are not paying attention to ESG. So you've got certain things in play in almost all of these.
Yeah, so really the danger here of a bubble is if SPACs perform at a major rate poorly in investing in poor companies, right? I mean, it's a positive to go the SPAC route to raise your money, right? As a company, to go into those, it's a positive. People creating SPACs and buying into these SPACs, that bubble bursting is really just incredibly poor performance, and we haven't seen that. Is that correct?
Not yet. Not yet. You haven't. And I think a couple things about these initial raises, of capital through SPACs. They're averaging about $300 million right now. That's the new number. It's up a little bit, but down from last year. Kind of per SPAC is about $300 million. That's a nice starting point if you've got a good business plan. Most of the ones we've written about tend to end up getting $500 to $600 million because of the PIPE investment. But they're all going to need more money at some point. Nikola, for example, which was one of the early SPACs, that's kind of how we got onto the whole thing last year. They're going to need more money this year. They're building a plant, but if they want to have hydrogen stations and all the rest of it, they're going to have to go back to the markets and hopefully they'll be able to be successful there. But some of them say we've got enough money to fund our business plan. Some you just don't know.
And like all bubbles, so they're going to burst when the qualified companies they run out of qualified companies, right? And but there's still a lot of money to be made in SPACs and a lot of incentives to keep the market going. And then you get into lower quality companies, and that's when things really start unraveling. And I think at some point we have to. I mean, it's just a law of economics and physics.
Yeah, I think you're right. I think it's hard to say when that's going to happen. There's certainly a lot of money on the sidelines right now for investment, and this seems to be flavor of the month or months, I guess. Certainly, there's still private equity, and there still are IPOs. I noticed that Rivian, which is a really well capitalized electric truck maker, mostly pickup trucks to start with and SUVs. They're talking about a traditional IPO because they've got billions that's been invested by Ford Motor Company, by Amazon, and others, so they can kind of take their pick. Another one that's kind of interesting that way is Too Simple, which is an autonomous truck company. They have gathered a lot of money from a lot of companies, and they're sort of making their own decision on how and when they'll go public. So they're not going to be captive to SPAC people looking for a quick buck.
Exactly right. Well, thank you very much for joining us today, Alan. Dooner here is on LinkedIn asking if you're in a dojo right now.
I am not, but those panels behind me came from Shanghai, where we lived about 20 years ago, and they're pretty darn cool. Thank you, Dooner.
I thought he was.
They are very cool.
I thought he was broadcasting from Nepal, to tell you the truth.
And as our audience, reach out, pitch your story ideas, become a source, talk to you directly, Alan.
Okay. On Twitter, it's at Alan, ALAN, Adler, ADLER. My FreightWaves address is AADLER at FreightWaves.com.
Thank you very much again.
Thanks,
Always
Alan.
a pleasure. Always a pleasure talking to Alan.
Oh yeah. Very smart guy. Very smart guy.
Yeah, and I'm fascinated by SPACs. I don't know if anyone else is, but I'm fascinated by them.
Yeah, I mean, it's very interesting to me as well, the dynamics there, and it's very it's a little bit scary to invest in one, knowing that they haven't, they're searching for something you really can't control, and
I know, right?
It's a little.
I know.
Anyway.
Well, something else I really like to talk about is freight brokerage. 3PLs.
Yeah, me
right?
too. Yeah, absolutely. And right now we're bringing our next guest. We have Mr. Bill Driegert, head of operations at Uber Freight, on with us right now. Bill, how are you this morning? It's morning for you. How are you?
Yeah, morning for me. Afternoon for you. Afternoon, gentlemen. Doing well.
Excellent. So, I think most of our audience is familiar with Uber, but a quick background on yourself, sir, and let's jump into this.
Sure. So I'm the head of operations here at Uber Freight. Uber Freight started in 2016. I came on board to help build it up, and it's been a rocket ship since then.
Yeah, it's been excellent. So, we talked earlier, and we were talking earlier here, and we had a bunch of comments of people saying, basically, gentlemen hauling for Uber in Canada, and another saying, I hope Uber does well in the parcel deliveries, creating jobs, et cetera, which isn't exactly Uber Freight, but. We were talking about your enterprise offering that you brought out, and we talked about that earlier, I think in the fall when that came out in September, whenever that was. Can you speak to that and how that's been going for you guys?
Yeah, absolutely. So last year we saw significant growth in our API. We also launched our enterprise product and our link product. We've seen significant growth in that in 2020. A lot of that was just driven by volatility in the market and our shippers wanting to have better tooling, better technology, better access to information. Quarter over quarter, just between Q3 and Q4, we saw 45% growth in customers using that technology. And really what it is we started with our pricing API, which was an enterprise solution, us meeting the big shippers where they were, giving them new information, giving them instant access to prices and capacity. And then we expanded that with our enterprise product and with our link product, which are really us taking a lot of the tech we've developed internally and externalizing that and finding these places where we can plug it in to provide better visibility, better access to capacity, to give them more tools in their tool chest.
And when you say, let's talk about tech enhancing capabilities. I was going through the investor presentation that Uber published yesterday and talking about marketplace. And this number jumped out to me is 50% plus of loads now offered are bundled or in bundles, and how technology, could you comment on how technology helps bundling loads?
Yeah, bundles has been a big success for us. So as you mentioned, over 50% of loads are in bundles. And when we execute on a bundle, we see a 23% reduction in empty miles, which for a carrier is significant. And it's ultimately tech allowing our carriers to make better decisions around how to link loads together is what bundles offers. It depends on density. So as we've scaled, bundling has gotten better. As we've got more loads on the board, you can make better bundles. So it's it's a great flywheel once it kicks off. But that's one area where it's a pure tech solution where tech clearly provides an advantage, because as a carrier, it's hard to parse through all the loads that are available or keep track of when loads come into the market, when they leave the market, and build a bundle together an efficient route, as where we know we can do that effectively. We also know what loads are coming. We can predict what loads might come. We can be very thoughtful and proactive about bundling that freight together for the most efficient route.
Yeah. Yep. So, Bill, we were talking about the enterprise solution, and when we talked about that before, we were talking about kind of this external people were looking at what was going on at Uber Freight and seeing this kind of shift. Although you pointed out that it's never really been skewed one way or the other towards the carriers or the shippers, but externally it looked like this rather good pivot or shift or addition to the business model to really bring in the shipper and not just garner all of the capacity that's out there in the drivers, right? And that enterprise really seemed to fit well with the large shippers. So now we're starting to talk about small shippers in Uber and what you're doing there. How is that evolving? Can you talk to that?
Yeah, and I'll touch on a little of that narrative, because it is very much how we thought about the market. When we came to the market, we focused on the small carriers, partly because that was the easiest market to address right out of the gate. You could download an app and use it. Yeah. And when we started developing technology for shippers, we started with the small shippers and then moved to the larger shippers. And again, that's because the large shippers, they have existing TMS systems with billion-dollar investments in them. You have to meet them where they are, and you have to build more specialized capabilities. With the small shippers, we launched our shipper platform, and we've been scaling capabilities on that year over year over year. Most recently, we announced our rate lock feature, which is another feature which I expect to make it into the enterprise as well. It's real-time contracts, and I'm a big believer that pricing and execution will become more and more automated over time. And this is a trend that accelerated in 2020, will only farther accelerate in 2021. And I can't overemphasize how big a shift this is, to have access to real-time contracts where a small shipper can go into our portal, get a 3-month commitment, and do that in an instant versus having to send emails, going through the traditional negotiation process. And of course, now that it's available, right, that's a capability that I only expect to expand over time.
So in the real-time contract, so what you're saying is it's kind of like going in and what we traditionally think of how you get spot pricing, right? But extending that to the contracts and doing a 3-month or a longer-term contract or commitment than just one-off freight, right?
Yeah, exactly. Right now, it's a 1 to 3 month contract. I'm a big believer that a lot of the effort that goes into RFPs and traditional contracting is wasted effort, or there's just a ton of friction and overhead involved in that. Mm-hmm. And in a traditional RFP, there's interesting studies that show that the RFP the average half-life of an RFP is about 4 months, meaning within 4 months, half of the lanes that were in an RFP are no longer valid, or the volumes never showed up, because it's based on a forecast, and forecasts are inaccurate. Yeah. So we started with 1 to 3 month contracts because shorter contracts are typically more robust. You can typically predict 1 to 3 months more effectively. But traditionally, people don't contract on 1 to 3 month terms because it's so much overhead. But now that it's a one-touch execution, real time, I get a contract, it's easier. So I can think in shorter time periods that are more realistic for my planning cycle. So I do think it's a fundamental shift. The problem with contracting historically is just that it's highly burdensome. It's not very accurate, and it creates a whole ecosystem of correction and buffer and poor planning decisions that having instant access solves all that, an instant contract.
I agreed with that, definitely. I mean, the normal RFP process takes 3 months. So
It
you don't want a
does.
3-month contract when
Yeah.
it takes you 3 months of work to actually do it, right?
Well, yeah, and it's interesting because last year we were talking about mini bids, right? Companies trying to do that because everything went out of whack last year. And in case you didn't notice, Bill, the freight markets were crazy. We'll talk about it after. Just nod your head and say, yeah. But it was nuts. So this could be a tool to solve that for even large shippers, right? And want to do these mini bids. Is that right?
Absolutely, because a lot of decisions we make in a supply chain are not 1-year decisions. They're 1 month, 3 month decisions. They're short-term sourcing decisions. And particularly last year when the market was so volatile, it's just not a responsible decision to make a 12-month commitment when you're in the middle of a highly volatile market. You have no idea where freight rates might be 2 months from now. And so shorter-term contracts do solve that. They give you a little more certainty and resilience in the near term without having to make a commitment that might be underwater in 6 months or worthless because the market shifted the other way.
So with that said, Bill, what's your outlook for 2021? Where are we going from here? We talk about the freight markets all the time. I'd love to get your opinion.
Yeah, it's been interesting. I mean, rates are still elevated year over year, but we are seeing more of a normal seasonal trough in terms of entering January and February. It's, I think the consensus now is capacity. We have seen peaks in terms of Class 8 orders, so capacity is coming into the market, and demand seems to be more normal to down. There's an opinion that a lot of the durable goods got pulled forward, so it's still a bit of a wait and see, but we are seeing at least more of a normal seasonal trough, and there's into the consistent rate increases we saw last year.
Bill, before we let you go, I wanted to ask a follow-up question to the previous question that I asked about the usefulness of this feature to large businesses. Is when you're talking to the smaller shippers, right? That the tremendous overhead and the effort that goes into, and I agree with you, much of the energy is wasted in the RFP process. But there's other benefits as well to utilizing this rather than spending the time to constantly be going out into the spot market. Correct? I mean, there's other benefits for smaller shippers to be utilizing this new feature, right?
Yeah, absolutely. Small shippers particularly are more beholden to the spot market. So they traditionally didn't have access to contracting tools, or they may not have gone to market with contracts because they didn't have enough freight to bundle into an RFP. So they fall into this, no man's land traditionally. If they might have enough freight that they want to contract, but it's not enough to go through an RFP. And so they then become beholden to the spot market. So it does create a new option that small shippers just didn't have otherwise. So I talked about the high level benefits and my grand vision of how this can change how we think about contracts, but really there's this immediate opportunity to just improve the contracting and the procurement capability of these small shippers.
Cool. I'm going to give out your personal cell phone number after the show for people who wanted to learn more. But right now, you can. Where would people learn more about this new tool that you guys have here in the enterprise solution, Bill?
Yeah, if you go to freight.uber.com and just check out our website. You can get to the right contacts through our website.
And Bill Bigrig Barbie says, way to go, supporting the small shippers by scaling. This is what technology does. So a compliment there for you.
Yeah, happy to help. Always happy to help.
Great. Thank you so much, Bill. You have a great day.
Yep, you as well. Thank you.
Always fun talking to Bill.
Oh, yeah. Bill's a great guy.
Yeah. Always a lot of things going on at Uber Freight, and always good to hear about. What's sometimes good to hear about and sometimes not good to hear about, depending on what cycle we're in, is the weather. And I think Nick Austin is here with some more bad news.
Unfortunately, it's really bad in Texas. Other parts of the South, this ice storm is just wreaking havoc, for lack of a better phrase. So I think we have some video, though. This is from Fort Worth from earlier today. It may have started during the overnight hours and then, of course, lasting past sunrise. But earlier today, a major pileup involving dozens of cars and trucks, tractor trailers, you name it, in the Fort Worth area on Interstate 35. This was due to icy conditions from the freezing rain. Dallas-Fort Worth Airport reported periods of freezing rain and freezing drizzle from about 3 until 7 o'clock local time this morning. It has stopped there, but you can see the trouble that it causes. And Dallas, Arlington also had accidents. And overall, in those 3 areas, 8 people have died from these accidents, all because of the freezing rain and the icy conditions. That ice storm is going to continue from parts of Texas all the way over into the mid-Atlantic. So a lot of areas affected, including Little Rock, Memphis, up into Kentucky, West Virginia, and then later today and tomorrow lingering in the mid-Atlantic. So possibly some freezing rain and snow in parts of, say, Baltimore up to around DC, Philly. I can't rule that out. So some parts of I-95. Now, I do want to talk about another storm that's unfortunately going to hit Texas and other parts of the plains for the weekend. There's going to be heavy snow off and on over the next few days in the Pacific Northwest. And some of that snow will hit Seattle and all the way down to Portland. In the cities, there could be accumulating snow. They're not used to that. But that storm's going to land in the plains and across Texas for Sunday, which is Valentine's Day, and probably lasting into early next week. So there'll be accumulating snow here, which could get, believe it or not, close to the Houston area. Maybe not right downtown, but in the northern suburbs of Houston. Dallas will probably get snow. Those are some parts of Texas that aren't really used to seeing it, but up in northern Texas they are, and it's going to affect parts of the Arklatex region, mid, and even some areas of the lower Mississippi River Valley with some heavy snow and possibly more sleet and freezing rain. So this is not ending anytime soon. The cold air is starting to really filter down into parts of the south, where it's been sitting over the northern plains and the Great Lakes now since last weekend, that Arctic air. And even some parts of Texas and the plains could see temperatures below zero heading into the weekend. So not going to be improving anytime soon with that cold weather sticking around. A lot of the roads are just going to stay frozen and in really, really bad shape for several days. Power outages too, guys.
Well, thank you very much, Nick, for all the positive news there.
Yeah, I don't know if the people in Texas are appreciative of you keep sending all this ice and snow down their way. Very, very frothy of you, Nick.
Thank you again for that update, Nick. So yesterday we had the Healthcare and Pharma Supply Chain Summit.
Yeah, we certainly did. It was quite an event. It was a very interesting event.
Yes, it was, and you can find that on demand
at
live.freightwaves.com and tv.freightwaves.com.
Yeah.
It was great.
Yeah, it really was. And, it's one of the interesting, you were talking with Katrina Lytle, is that right?
Yes.
And one of the things with XPO.
XPO, yeah. She's president of
I think one of the things that
Forwarding
stuck out with me from that one there was her explaining, really, we've done this before. This is what we do. This is what we do. It is the sheer volume magnitude of this that is really causing it. And some of the things looking forward and what we've learned so far in the vaccine rollout, et cetera, was very interesting to see, and how that can be smoothed out. So that was really good stuff.
Yeah, and then our next virtual conference coming up, February 22nd to March 3rd, is the Global Supply Chain Week Plus. And we're kicking off on February 22nd with aerospace, military, manufacturing, rolling into retail and building and construction into Tuesday. Into Wednesday, we have CPG, food shippers. Thursday, the automotive supply chain. And then Friday are, energy, mining, agriculture, chemicals. And then March 1st through 3rd, we have the Global Maritime Solutions right there.
Yeah.
Steve Farrar, Gary V.
And Gary V.
Gary V is going to be on there. Bob Corker.
It's going to be awesome. It's going to be awesome.
It is.
Yeah. You know what we have tomorrow?
What the Truck?
We have a What the Truck tomorrow, and it's going to be another good one. We'll see if I ask the Freight Bambino what his name is, if he mysteriously gets cut off again. Every time we try and find out his name, something happens.
I think he does it on purpose.
I think he does too. That was. Although many people do know their name, they won't tell us what it is. But tomorrow on Friday is What the Truck at noon. How modern truckers are building their business with solid fundamentals and side hustles that are turning small money into big bucks. Everything you need to know about marine cargo insurance in 21, and when to know when dedicated capacity is the way to go. And we've got who we have on there. We have Deliverite launches the first heavy goods delivery app for Shopify. Have you seen this? It's really interesting. We have special guests. We have Freight Bambino, Truckerpreneur, Bambino Cattle Company, and Mark Cooner, EVP. Huh? Yeah. No. No.
Oh, it's great. I think Eric Serta over at Valor did the graphic design for it.
Oh, yeah.
But it's a great tagline. It's all hat, no cattle.
That's awesome.
Yeah, that's his logo.
I love it.
Yes.
I love it. That's very good. Mark Cooner, EVP of Strategy, Transportation, and Automotive, Engineering and Manufacturing, Chemical and Energy, North America at DHL Supply Chain. That's one title, my friend.
Wow.
I can't wait to talk to him and see how big his business got. Steve Roy, president and owner of Landstar Agency, with a comeback story, and Rick Bridges, vice president, client development, new product development, Roanoke. It's going to be a great show.
It is.
And, yeah.
It is. I can't wait. I can't wait for it. And, to register for the Global Supply Chain Summit coming up on February 22nd through March 3rd, go to live.freightwaves.com. You can see all of our past events. All the video on that is in demand or on demand. And you can register for the event coming up. You can get What the Truck, Midday Market Update, Put That Coffee Down, the Freight Sales Podcast for Closers, Freightonomics, Great Quarter Guys, all our great lineups here, and plus conference sessions on podcasting.
You can even
Freightcast.
get with Sonar on that as well.
Yeah. Just look for Freightcast wherever you download your podcasts.